Hello, Avila Finance students. We are now in week 6, so keep plugging along in the course, and we're getting closer and closer towards the end to the holiday break. I want to wish everyone a happy Thanksgiving this week. What I've done is I've asked you just this week to do something for someone. There's no forum discussion. I'm going to give you a little bit of break this week, so I've given you credit for that. But in the spirit of the Sisters of St. Joseph, we try to be altruistic and help others. So instead of the forum discussion, I just ask that you go out and be thankful for something, or tell someone something you're thankful about, or go out in the community and do something for someone. But with this week, we have 2 chapters we're going to look at. These chapters look at what I would call business risk and financial risk. The business risk is due more to the operations. Just because you have a business, there's no guarantee that you're going to get profits. It has to be managed well. People have to want the product. There could be things that external regulation, government, just the change in taste and preferences can impact the demand for your product or service. So managers do have to take those things into consideration. The financial risk side is that, are we going to be doing well enough, or how much debt are we using? Are we leveraging ourselves? So we'll talk a little bit more about the optimal capital structure in your reading, but 2 sides to it that we're looking at that. And then also, we get more into the concept of break even. If I have to produce X amount of planes in order to just break even, or cars, or how many people do I have to come through a restaurant to make sure we cover all those fixed costs. So in finance, we typically just look at a linear break even point, but if you think back to economics, we understood that the cost curves were much more U-shaped, and the idea that I can just keep expanding this profit level forever and ever is not realistic because of certain constraints, such as our plant size and our fixed inputs. At some point, we start to get diminishing marginal returns as we continue to grow. So managers have to think about the various size of plants and restaurants or whatever it would be. But with that, you're going to read things such as operating leverage. It's the impact to profits with relative to our fixed cost. And some companies have very high fixed costs, like auto manufacturers, and they tend to have to produce a lot of cars before they can break even. But once they can break even, like say on the Ford F-150, that sweet spot or the profit margin can be quite attractive. I think, in fact, for Ford, they make a lot of their money off those Ford F-150s. They sell them for $50,000 to $60,000 sometimes, and probably once they get that break-even point, they can make a lot of money on them. If you have a smaller amount of fixed costs, you can probably break even faster, but the question happens, what if you grow? Then I'm probably going to need additional warehouse space, more expenses, so the profit margin may not be as much. So it's just a question the characteristic of your industry, and what are you going to need to break even. Also with that, it talks about financial leverage, and one of the benefits of using debt, if you go back and think about the after-tax cost of debt, is that on an income statement we get to deduct interest expense of debt. So there are tax benefits. However, with debt, it has to be paid back. With stockholders, it does not have to be paid back. So we can definitely leverage ourselves to give a greater return to those shareholders. That is, I can use a lot more debt, help lower my tax liability, give more profits to the current existing shareholders. But the problem happens is when I have a lot of debt and the business is not doing well, then I get in trouble because, what happens if I can't pay off all this debt? And then probably those in the market that rate you are going to downgrade you, like Moody's and S&P, and then you're going to have to find more people that are willing to lend to you, and it's going to be at a higher rate. So that's some of the risk of using debt, but it can definitely magnify your returns, or it can magnify your losses. Also, you're going to talk about the capital structure. What is the ideal capital structure? Tying in that idea of debt having that benefit. But at some point, we start taking on too much debt. The market will probably tell us too, and actually that's going to impact our cost of debt too. So we're going to see our interest rates rise. So, depending on the nature of the industry, some firms like tech firms are probably going to be very heavy in equity because they just don't have a lot of physical assets. But if you're an airline company, if you're a hotel, I can probably issue more debt, more bonds, because I have something backing it up. That is, if the bond fails, I can go in and cash in on the hotel and sell it. So it's going to vary on your industry structure too. Last thing to just talk about is the dividends. And I may have mentioned this in a few posts last week, but GE provided us a great example last week just to show that, hey, when things get rough, they had to cut their dividend in half. It went from like 24 cents a quarter down to 12 cents a quarter. And their stock price took a big hit, trading as low as $17 from a high of like $32 this year. And investors had bought that stock because they anticipated they would always pay a steady dividend every year. And management got themselves in trouble in probably paying too high of a payout ratio. That is, of all the earnings that you have, I should say profits, they can decide to keep some as retained earnings, or they can decide to pay some out in the form of a dividend. And they got themselves in a situation which managers don't want to do, is the inability to pay that dividend. So most companies are actually quite cautious with their dividends, even though the company is growing. Usually most young companies wait to pay dividends, but as the company matures and they really don't have other investments, they will start to give some of that cash back in the form of a dividend. In fact, Microsoft probably 6-7 years ago had so much cash sitting on hand, and they really didn't have any viable projects that would meet their opportunity cost. They said, you know what, we need to just give it back to the shareholders, because they can go out and make decisions with that money, decide what is best for their risk and their opportunity costs. And that's what they did. They paid a huge, like, one-time big dividend. Some other things that companies may do is they may engage in stock splits. In fact, with GE, maybe that's something they will have to think about and consider. They may actually do a reversal, and for every 2 shares, you may get 1 share. So just to kind of bump it up in the perception of the market, I don't know if they'll do that. And they may consider buying some of that stock back. If they're selling off all these industries, what is the benefit? It could almost dilute the shares. So they got some tough decisions ahead. They're a very large conglomerate, but hopefully GE can figure it out in the long run, get their stock price back up. So that's what they're trying to do right now. Well, that's a summary of this week, but again, main thing is just to work on your homework problems, get those done early, get those submitted, kind of enjoy the holiday break, and then we'll pick up on the forum discussion in week 7, and soon we'll be approaching the final exam. So just keep plugging along, and you all have a great, happy Thanksgiving, and I will talk to you later.